Today we're looking at big banks' exposure to commercial real estate. For more, we're joined by Bloomberg's Todd Gillespie. So Todd, you've been reading some studies about this that are a little bit more, I don't want to say fear-mongering, but they're slightly tell us that there's cause for concern.
No, certainly, Vonnie. I mean, there's a new study out just today from a very well-known professor at NYU, Viral Acharya, former deputy governor of the Reserve Bank of India, where he was a bit of a superstar back in the day when he was helping run monetary policy there. A bit of a sound, sounding the alarm from him and his colleagues here, just talking about the off-balance sheet exposure of some of the largest banks in the US who've largely been left out of the conversation when we talk about bank exposure to commercial real estate, looking at this area of shadow banking, where essentially they are lending through credit lines and term loans to real estate investment trusts, which generally haven't had as much scrutiny when it comes to the on-balance sheet exposure that banks face in the US. Part of their argument is that credit lines that REITs have in particular tend to be drawn down in times of stress much more than other sectors. And when you take this into account, actually these risks that face these banks, particularly in times like COVID, during the financial crisis, could be more accentuated than people at the moment appreciate.
Well, and fascinatingly, these REITs, they have to make large dividend payments in order to attract investors, but they don't tend to pay that out of anything other than things like term loans and so on. And that's where the problem begins, and we all know then it becomes a little bit like a bank run, or it could potentially be.
Precisely, and part of the danger is that these tend to coincide with moments of distress for the wider economy as a whole. So precisely when banks need greater capital to lend out to other clients who could be borrowing at higher rates, or they need that capital to shore up their balance sheet and for other reasons, that's exactly when these REITs are often most stressed. And part of the argument that these authors make is that these banks are also underpricing the rates that they're offering to these REITs. Basically, they could be charging more and earning more on those loans. And they've used a couple of examples, for instance, the Blackstone REIT in 2022, when later in the year they limited redemptions on that big fund, which, as you'll remember, made a lot of headlines. They looked back and actually showed that they increased their credit line access to B REIT, but actually the rate that Blackstone was able to achieve, despite a clear increase in credit risk, was basically the same as they had earlier in that year.
And didn't Jamie Dimon say that he was actually shocked at some of the ratings that these entities were getting?
Right, exactly. And I think some of that, as a whole, basically adds to this broader debate, as you're right, partly from private credit firms, partly from REITs as well. There are lots of entities where banks are exposed on off-balance sheet basis, which tend not to get as much scrutiny from regulators, as much appreciation from the market, partly because there's this information gap, which people don't have as much access to. But actually, in many ways, the banks are still sort of, as these authors say, touching the feet of these systems as a whole.